Welcome back. Well, it is earnings season. Q3 earnings season is here, and it starts with TCS on the 9th, which is on Monday, and Infosys and HCL Tech on the 12th, and Wipro on the 13th of Jan. The big question then is the slowdown easing or worsening, and is a slowdown priced in after the 30% underperformance last year? Rima standing by at the big wall with the key expectations from the IT space this quarter. Rima.
Thanks so much for that. So let's tell our viewers what we can learn and hope to learn in this quarter's results and commentary. Now remember, Q3 is typically a soft quarter seasonally. But this quarter, growth rates will further moderate given the higher furloughs. Remember, HCL Tech has already highlighted that we are seeing higher furloughs in 3 key verticals. They spoke about high-tech, BFSI and telecom. Now let's pull up the CNBC-TV18 estimates on the growth expectations this time. The top 5 IT companies are anticipated to report a growth anywhere between 0.5% going up to 3.5% for HCL Tech. But if you compare with this December of last year, where the growth rates averaged from 2.5% going up to 6.5%, you would see that growth is slowing down. That's point number 1. So what do we want to hear from the management to understand the future demand? 1, will the furloughs continue into Q4 as well? 2, how are the tech budgets for this calendar year? If the tech budgets are flat, and if they're not growing, and if large deals are absent, can IT companies see double-digit growth next year? Number 3, is there a moderation in the deal win outlook? And what about pricing? Is pricing under pressure? And finally, watch for the hiring numbers because they are a proxy for future demand. Now let's talk about the margins and the expectation. Now the CNBC-TV18 poll throws up that margins are likely to expand for the 2nd consecutive quarter for the IT companies. This is aided by an INR depreciation and 2, declining attrition. So TCS's margins are likely to expand by 70 basis points. For Infosys, margins are likely to go up by 30 to 40 basis points. Now, while margins are improving, a point which has been made by the IT bears is that margins are still significantly off compared to the peak levels that they hit post-COVID. Remember, in the immediate aftermath of COVID, IT companies had cut back on hiring, salary, travel costs were zero, and margins had surged. Now, the question is there scope to improve the margins from current level given that attrition is on a declining trend? Or will growth offset any margin improvement because you need operating leverage to kick in to improve margin? Now let's talk about the guidance. The annual guidance is given by Infosys and HCL Tech. Infosys is likely to retain its FY23 guidance on revenues and margins, and so is HCL Tech. HCL Tech, in fact, just last month had already tweaked its guidance, right? They had indicated that growth rates this year will be at the lower end of their guided band. So don't expect any change. Wipro gives you a quarterly guidance, and next quarter's guidance is likely to be muted at 0 to 2%. But as we've been saying, the question is really on future demand, FY24 and FY25. And here, unfortunately, the results are unlikely to give you any strong quantitative signal on FY24 outlook. And then let's move on to the stock price and valuations. Now, last year, the Nifty IT underperformed. The Nifty IT index was down 25% versus the Nifty, which was up 5%. Now, the Nifty IT has underperformed the markets consecutively only once in the past 15 years. So will this support a trend reversal? Can Nifty IT recover? Or given the fact that despite the correction, valuations are still at a premium to historical levels, will we see valuations correct back to their pre-COVID levels, driving a weakness in the stock? Back to you.
Rima, thank you so much for joining us. So that's what you can expect from the IT sector this time around, and it's time for a break on that note. On the other side, Manisha Gupta will join in with Raj Manohar Somsundaram of Aqua Connect. Stay tuned.